Hi guys, very good evening all of you. How are you? So, Sarah, can you say hi?
Hi, sir.
Hi Sarah, how are you?
I'm good, sir. How are you?
I am good too. So tell me, what is today's date?
22nd.
Two.
Uh,
Correct? Eh?
yes, sir.
Sorry, tell me. What is the topic we are going to discuss today?
Employees stock option scheme.
Employees
Stock option scheme.
stock options scheme. Okay, Esop we call accounting for employee stock option plans. Accounting for employee stock option plans. Okay, now tell me, what is Esop? Now you will tell we have paid the fee. You have to tell sir. Please understand the process. Eh? Okay, so you might be knowing this Sundar Pichai, Satya Nadella. Have you heard of these guys?
Mm.
What is that? TV? Eh?
Someone's audio is on.
Someone's audio is on. Okay, guys, all of you, please put it in mute now. Okay, Sarah, have you heard Sundar Pichai, Satya Nadella, these guys?
Yes, sir.
Okay, so who's Sundar Pichai?
Something Google.
Eh?
I heard names, sir. Please don't ask for specific.
CEO of Google.
Uh,
Satya Nadella is CEO of?
no idea.
How are you surviving in this bloody world? Sandeep, tell me, who is Sundar Pichai?
The CEO of Google.
Then who is Satya Nadella?
The Microsoft.
Okay, so they are Indians and they are CEOs of global big companies. Okay, so this guy Satya Nadella's salary is reportedly, we do not know exactly, in terms of Indian currency. When you convert that into Indian currency, it is something like 515 crores per annum. What the hell is this? Sarah, that means on an average for effective one working day, you will get 2 crores.
Wow.
So if you take all the Sundays, Saturdays, holiday out of 365 days, around 104, 105 Saturday, Sundays will be there. After that, holidays will be there. So if you remove all those things, effectively, they'll work for maybe around 220 days, something like that. So on an average, if you take that effective working days, and if this is the salary per day, he will get effectively 2 crores.
Oh.
Nice money, no?
Nice. Yes, very nice.
So if you get that job, what will you do? No, Sarah will tell, sir, I will work one day, evening, I will get 2 crores, put that in a bank FD and I will retire, sir. Correct? Huh?
Yes, sir.
Sandeep will tell, sir, for me, 2 crores is not enough. I'll work 2 days, sir. With 4 crores, I will retire, sir. So, do you think this money, they will give in cash, like, you can withdraw that at the end of every month? The answer is no. The answer is no. Major part of this will be stocks. Major part of this will be stock. Minor part only will be cash drawable salary. So in this approx 80% of the money will be only in terms of shares. That means you work for 5 years, 10 years as per the contract. After that, you can unlock, you can take all these shares. So these shares are given to employees. Normally high-level employees like directors, general managers, etc. It can be given to all the employees also, but normally it will be given to top-level employees, high-level employees. Okay, so this is based on some conditions. So the management is saying, dear employee, you are entitled to get shares in our company. provided. That means conditions. There are two types of conditions. One is service condition based on time. Second one is performance linked condition. One is service condition based on time. Second one is performance linked condition. Service condition based on time means work for 5 years and then take shares. Performance linked conditions are like, the market price of share should touch ₹500. The return on investment should be more than 12%. The EPS should be more than ₹4. The net profit ratio should be so and so. Gross profit ratio should be so and so. Sales should be so and so. Profit should be so and so. Like that, if you are attaching any condition, this is called performance linked condition. So work for 3 years, 5 years, and then take share is service based condition, time based. Then performance based condition will be there. In CA intermediate level, majority of the problems will have service condition. Work for 3 years and then take shares. Work for 5 years and then take shares. Okay. Now understand the word option. Option is basically a right, but not an obligation. Option basically is a right, not an obligation. So Miss Sarah is working in X Limited or Infosys or some company, and X Limited said, Sarah, complete 5 years of service in our company and take 100 shares at a rate of ₹250 each, whereas market price of share is ₹400. So what is the market price of share? 400. If you want to purchase a share in stock market, you'll get it for 400. But because you worked 5 years dedicated in the company is giving it at ₹250 only. But this is only an offer. Sarah is under no obligation to purchase. If she wants, she will buy. If she doesn't want, she'll say, sorry, sir, I don't want shares. So employee can encash, can accept the offer, or he may reject the offer also. He may reject the offer also. You understand? So on 22/2/2022, X Limited offered 500 shares to employee on Esop, subject to a condition that the employee has to work for 3 continuous years. Okay, so 22/2/2022 is called grant date. It is called grant date. On this date, the company granted option. 3 years is called vesting period. 3 years is called vesting period. Okay, so you need to work for 3 years. It is called vesting condition. Period is 3 years. What is vesting condition? Condition is you need to work for 3 years. That is the condition. Okay, so on 22/2/2020, 22, 23, 24, 25, 25, you are eligible for shares provided you are still working. You are still working in company, then you are entitled. And then to pay cash and to take the shares, they will give you some excess period that is called exercise period, say 1 year. So you're eligible on 22/2/2025, but on the day immediately the company, if it asks you, hey, pay cash, you may not have cash. So to pay cash and to exercise option, they'll give you some more period. It could be 1 month, it could be 2 months, it could be 5 months, it could be 1 year. So they'll give you some exercise period within which you can purchase that shares. So this is more or less broadly the story. This is the story. So all of you read this few lines and try to understand the example. Read this few lines and understand the example. Once you understand the example, then we'll go to the accounting. Sandeep, can you read the example louder?
Hello, sir.
Hi, Sandeep. How are you?
And thank you, sir.
Super. Read.
On 22nd February 2022, X Limited offered 500 shares to employee on Esop, subject to a condition that the employee has to work for 3 continuous years. 22/2/2022 grant date, 3 years vesting period, work for 3 years vesting condition. On 22nd February 2025, you are eligible for shares provided you are still working in company. Exercise period 1 year.
You understand this example, ma?
Yes, sir.
Okay. Now, so take one share. Take only one share. What is the fair value of share? In our example, what is the fair value of share? 400. What is the exercise price for employee in Esop? 250. Correct? Hey. Yes, very good. Now, employee pays 250 rupees to the management and he will get a share. Now, in whose books we are writing this journal entry now? In whose books we are doing accounting? Guys, can you tell me in whose books I am doing this accounting? Am I doing it in company which is issuing share, or am I doing it in the books of employee? Am I accounting for this transaction in the books of company, or I am doing it in the books of employee? Tell me, everybody. Only 2-3 answers I got. I want more. Come on, dude. I want everyone to answer. Dharini, correct. Vrinda Menon, correct. Priya, CON, seriously. Manoj, correct. Company. Okay, now you tell me journal entry. I received 250 rupees cash. I have given share. Okay, say for example, face value of share is 100 rupees. Face value of share is 100 rupees. Tell me journal entry. Sandeep, turn on the mic and tell me journal entry.
Cash account debit.
Very good.
250. To equity share capital 100. To securities premium 150.
Super. So the chapter is over. Can we go to next chapter?
Sir, is it securities premium?
Securities premium, correct only.
Okay.
The kind of bakwas journal entry you told, I want to finish the chapter here itself.
Okay, sir.
Sandeep, that is wrong journal entry.
Yeah, that's why I asked once more, sir.
Security premium is correct, ma. There is no mistake in security premium.
Oh, okay.
To security premium is correct.
So cash is wrong.
Cash is also correct.
So equity share capital will be wrong.
No, that is also correct.
Sir.
This is legally what has happened. But
okay.
It is not the substance. It is not the economic reality. Now tell me one thing. You have given 400 rupees share to 250 rupees to your employee, correct?
Yes, sir.
Why?
Because he has worked for 3 years. So
correct. Very good. So is it out of your love or you are getting benefit?
Because of the benefit, sir.
Yeah, you are getting benefit. That is not, there is nothing called love.
Okay.
Maybe when you say, I will give you shares, they will work harder.
Okay.
They'll work motivated. They will do extra for you. They will get the ownership of the company. They will get a good sense of feeling, attachment. So for that, you are paying that extra 150, correct?
Yes, sir.
So is there any element of salary given to him? Can we consider that difference between this 400 and 250 is salary? So you are giving 400 rupees worth share to one guy. You are giving, hello, you are giving 400 rupees worth share to one guy, but you are getting only 250. Are you losing that 150? No, you're not losing that 150. For that 150, you are getting services of the employee. That means that 150 rupees is hidden salary. Sara, Dharini, everyone is saying in the chat box, no, that is not salary. But my dear friends, try to understand that is salary. That is salary. See, simple. Sara, turn on the mic. I'll tell you one example.
Yes, sir.
See, for example, you have a phone, okay?
Mm.
You want to sell the phone.
Okay.
Okay, you know that fair value of phone is 10,000.
Okay.
If you sell this phone in market, you will get how much?
10,000.
10,000. Now, Pavan asked the price.
Mm.
So I asked you the price. Now you are hesitating. This guy is my lecturer.
Mm.
Okay, you said, sir, it's okay, no problem, sir. You tell how much you'll give, sir. I said, I'll take it for 7,000.
Mm.
Then he asked me, sir, I have some doubts in auditing subject. You will give me auditing private tuition. Then I said, okay. Then you gave your phone to me for 7,000 rupees and you got auditing classes. Now you tell me what is the value of auditing classes in this example?
3,000.
Khatam. That is employee service cost.
Okay, understood, sir.
So now fair value of share is 400 rupees. Employee gave 250 rupees, but still the owner of the company is giving the share. That means share given is 400. Cash received is 250. Services received is 150. You understand?
Yes.
So the IFRS, this is based on global accounting. Okay. So in India, we have guidance note on Esop. After that, now in Ind AS era, we have share-based payments, Ind AS 102. So all these things are basically global standards. So globally, they realized there is no love. So this 150 rupees is not love. This 150 rupees is service.
Okay.
You understand? So this 3,000 rupees difference between phone and cash received is there. No, there is nothing called love. There is something called auditing. So the economic reality, that means the substance over form. So we don't want legal reality. What we want? We want substance over form. So this accounting is based on substance over form. That is economic reality over legal reality. So now what is the journal entry we need to write, you know? Cash account debit, how much?
250.
Then equity share capital, how much?
100.
Security premium?
300.
Excellent. So here balancing figure is there. What is that? 150. This 150 we write as salaries account debit.
Okay.
So instead of salary, what is the new name for salaries? Previously, when you prepare P&L account in T-shape form, you used to write 2 salaries, but now we changed the name. We are not calling it salaries. Employee benefit cost. Nothing but salaries. So we call employee service cost, employee benefit cost. This is nothing but salaries. You can write salaries also. But now we are calling it employee benefit cost. You understand?
Yes, sir.
So this is concept number 1. Guys, all of you, whoever is there in the class, do you understand this journal entry? This is economic reality. That's it. If you understand this, that's all. We'll do accounting like this. So everybody said yes. Now, Sarah, this 150 is for how many years? Ma? Is it for 1 year or is it for 3 years?
3 years.
How many years this is for?
3 years.
If it is for 3 years, how can you write this 150 in one P&L? You have to write this 150 in 3 P&L.
3. Okay.
Are you getting my point?
Yes, sir.
So, concept. Let us understand the concept. In concept, step 1. The difference between fair value of the share and exercise price is. Hello. The difference in fair value of the share and exercise price is. Excellent. Fair value of option. Correct, Sarah. Fair value of option. So, what is the fair value of share? 400. What is exercise price? 250. So, what is value of option? 150. So, this is concept 1. Do you understand this, all of you? All of you, please tell me, do you understand this concept? Value of option 150. Say yes in the chat box. Yes. Okay. So, meaning, what is the inference? Since the employee is working in our organization, rupees 150 is attributed to his services. That means it is salary paid to him. Indirect. It is indirect salary paid to him. So you understand this meaning, all of you? See, if a roadside guy comes and asks share at 250, I'll not give. Employee after working 3 years, I'm giving. Means what? For that 3 years, this 150 is the salary paid. This is concept 1. This is concept 1. Now step 2. Since the vesting period is 3 years, rupees 150 should be attributed to all the 3 years, but should not be recorded as expense in 1 year. So concept 2, do you understand, all of you? Is concept 2 clear? How we will do it is this chapter what we are going to study. That's all. All of you, do you understand step 2? Because 3 years service period, we are giving 150. It should be attributed to all the 3 years. But there is a requirement for estimating costs. Why do we need to estimate? Why do we need to estimate? Because today on 22/2/2022, I am granting options. Accounting should be done today. But when I consider 3 years period, there are so many parameters that will disturb my accounting now. People may resign during these 3 years. Yes or no? People may resign during these 3 years. Okay, and some people may not exercise option even if they are eligible. So don't you think this too is risk for accountant, risk, unnecessary headache for accountant? So today, if I record 150 rupees, tomorrow, if the employee resigns, 1 lakh employees are there. So 1 lakh employees into 150 rupees I have recorded. After that, 10,000 employees resign next year. Accounting will change. So considering these facts, what are these? Assumptions or estimations. Considering these facts, we need to estimate the best possible numbers for accounting. This is this chapter. Welcome to this chapter. Considering these facts that people may resign, some people may not accept, or if it is performance-based condition, how would we know whether ROI, 10% ROI, if it is condition, return on investment 10% is the condition, will it happen in 1 year? I don't know. Will it happen in 2 years? I don't know. Will it happen in 3 years? I don't know. That is the risk. You understand? Now, next point. Write down concept 1, concept 2, next concept 3. There are 3 types of settlement for Esop. There are 3 types of settlement. 1, settled in equity. 2, settled in cash. 3, settled in equity with cash option. Oh my God. Now imagine, Sarah, turn on your mic. Sarah, imagine you worked all the 3 years.
Okay, sir.
Now you are eligible for a share. You went to your manager. Manager said, hey, Sarah, congratulations. You have, you are eligible for this ESOP. Give 250 rupees. Take share. You said, sorry, if I take share, what is my benefit, sir? Then manager said, idiot, you will get 150 rupees free. Then you said, sir, please give that 150 rupees cash. Will you ask or no?
Yes, sir.
My sister, on the day of Rakhi, I was planning something to buy to her, okay?
Okay.
4 days, before 4 or 5 days to Rakhi, she called me. She asked me, hey, I have sent Rakhi in courier because we are living in different places. I have sent Rakhi in courier. I said, okay, thank you. Then she said, are you planning any surprise gift for me? I said, yes, I am doing it. And she said, I don't want any gift. And I'm like, wow, such a cute sister. She asked, you know my Google Pay? I said, yeah. Then send the money in a Google Pay. I have transferred 10,000 in Google Pay. Nice, no?
Nice.
Yeah, she said, I'll buy whatever I want. And she said, whatever you buy, I'll not like it. I want to go to shop and I want to do shopping because I have sent saree in Amazon once to her and she hated it. Okay. After that, she said, whenever you want to buy something, please, in the name of God, don't give any surprises to me. They are not surprises. They are panic attacks. You are bloody wasting money. I said, okay. So after that, Google Pay. So now Sarah also, what?
That is the best, sir.
Yeah,
even I don't like gifts people send me.
Oh, you don't like people sending gifts to you? You like only cash gift, huh?
I like gifts. I like gifts, but dress and all, I like to select by myself.
Okay. So fair value of gift should come in Google Pay.
Yes.
Okay. I know. More than shopping, you like the process of shopping, going to a shop, trying it. That process you like, isn't it?
Yes, sir.
Chalo, anyway, so I don't have anything to speak about that. So what I'm saying is now Sarah also went to the manager and said, Sir, you like me working 3 years, hard work, nice person. You are ready to give 400 rupees share for 250 rupees, but I don't want to share. I don't have 250 rupees. So please give that 150 rupees, Sare. Will they give?
They might give.
They will give. They will give. So they will give. Dharani, they will give. Dharani is saying no, they will not give. They'll give. If they do not give, they are not. They are accepting that their share has no value. Dharani, if the owner is saying I will not give 150 rupees, that means he is rejecting it. He is not standing on his promise. They will give. So, Sarah, I will give you one more example. Okay, 3 years back, before COVID, I have started this CAP classes. Okay. So that time, to make it popular, we are doing so many activities. So in that, what I have done is I have posted some MCQs in Facebook, and every week, whoever gives the best answers for that MCQ test, I used to send my person, with my autograph and with CAP classes sticker, we used to send one gift. So that gift I used to buy in Amazon, like, 200 rupees, 250 rupees. And majority of the gifts I used to give, they are books.
Okay.
First few weeks, there is super duper traffic. So everybody is answering. After 4 weeks or 5 weeks, slowly the kind of comments and response started coming down. I have an article assistant, okay? I called my article assistant and I asked why the damn traffic is coming down. Why number of people are not participating? Why this is coming down? She said, Sir, I can tell you, but you might not like it, sir. Then I asked, it's okay, no problem, tell. Then she said, do you think you are Virat Kohli? You sign and send a book, people will be happy. I'm like, what? It is bloody my business, my portal. I am giving it free to the student, but still he's not happy. She said, no. She said, a padipist like you maybe or will be happy to receive a book.
Yeah, right.
She said, tell them that you will send it, in cash in Google Pay. So I have updated my Facebook that guys, from next week onwards, in price we are not giving books and all. So book along with postage cost together, we'll give it in Google Pay. You can't even imagine, double, triple students started participating. That means paisa mein Paramatma. So the God is also in money. Now, can I take a back step? Can I take a back step after announcing? Can I say, no, I will give a book only?
No.
If I say, I have written one book on auditing, that book is 250 rupees, I will send that book instead of 250 Google Pay, people will throw stones and tomatoes on my face. Why? Because one category of people want this. But there will be some student who is genuinely in love with, the faculty or the teaching or the book or his handwritten that congratulations note. One student, maybe he will say, sir, that 250 rupees even I have. Can you please send the book with your signature? So some students will be like that also, no? Possible or no?
Yes, sir. Possible.
Yes, possible. So some people are like this. Some people are like this. Now I'm confused. What should I do? I should give option to the student. Do you want book or do you want Google Pay cash? Same thing is happening in Esop also. Now, do you understand this Esop clearly?
Yes, sir.
So either I can announce that participate and win equity, or I may say participate and win cash, or I may say participate, win, and choose whether you want to have cash or equity yourself. Okay. After that, what we have done, of course, out of the context, I'm telling you, I have one SBI International Platinum credit card. Okay. With that, every month, I will get 4 PVR tickets. Not only PVR, any theater. Every month, 4 tickets free I'll get. And even if it is like, PVR gold will be there, no, where seat will be 450 rupees, 500 rupees, 600 rupees. That also I can book free of cost. I don't need to pay 1 rupee also. So after that, I told students that, hey, you want 250 rupees cash, or in Lulu Mall PVR gold is there 600 rupee ticket, that 2 tickets I have, should I give? People are like, give it. Sandeep is saying how to get that. See, when you have a credit card, Sandeep, you'll get all this kind of nonsense. Okay. They'll give you dining vouchers. They'll give you, but of course you have to spend adequate amount of cash. Okay. So they'll give you Marriott vouchers. They'll give you travel vouchers. They'll give you this free movie tickets. That free movie tickets I've been getting for the last 8 years, but 99.9999% of the cases that tickets will lapse. I'll not book. And the rule is before 30th, if you do not book, next month it will not be carried. So that 4 lapsed, gone. So every time they will lapse. And there were so many situations where, like an idiot, I go buy tickets. After buying tickets, I remember, shit, I have that 4 in my credit card, I forgot. So I need to log in into that portal and I need to book. I'll forget that. So I'll buy the ticket. Then, during eating popcorn and watching movies, somewhere I'll get, array, yaar, I have free tickets, but I bought tickets. Congratulations to me. This is called idiots. Now, settled in equity with cash option is not there in our syllabus. Only 1 and 2 is there. Okay. So now imagine if this is the situation. Situation 1. After 3 years, you will settle your obligation to your employee by issuing equity share. After 3 years, you will settle your obligation to your employee by issuing equity share. Today, you realized that the employee service cost, that means salary, for this year is rupees 30. You tell me the journal entry. Dharani, can you turn on the mic?
Hello, sir.
Now Dharani will give one general knowledge doubt. Sir, while speaking shit and giving shitty examples and all, you will call Sandeep, Manoj, Sarah, and when asking journal entries, you will call me. What type of human being are you, sir? Madam, correct?
No, sir.
Tell this journal entry. She will ask, oh my God, do we need to pass any journal entry here? Yes. Tell. Salaries account debit to rupees, correct?
Yes, sir.
What I should write?
We are giving equity shares.
But we'll give it after 3 years. Today, how can I write to equity share?
We should create some account like
Yes.
adjustment.
Yes. Which account we should create?
Employee stock option adjustment.
Wow, super. Esop reserve. Wow, madam, what happened to you, madam? You have become so smart. Salaries accountability is up reserve. Now imagine, Dharini, if it is situation 2. After 3 years, you will settle your obligation to your employee by paying cash. Today, you realized that the employee service cost is 30. Now tell me journal entry. Salaries account debit 30 to, can I say ESOP reserve? If you are creating reserve, in future you will issue share.
Okay.
But if you create reserve, in future, after 3 years, there will be no obligation to issue share. There will be obligation to pay cash, which is a liability.
Okay, sir.
For liability, what do we create today? For future known liability, what do we create today?
Prepaid cash. Provisions.
Okay,
sir.
Prepaid cash. If it is live class, your head will be in 3 pieces. Prepaid cash. Provision for liability, ma.
Yes, sir.
Correct.
Yes, sir.
So how to ask? Do you understand?
Yes, sir.
I am asking you. You are from Tamil Nadu?
Yes, sir.
Tell me, how should I ask in Tamil to ask? What is that? Did you understand?
எல்லாருக்கும் புரிஞ்சதா?
எல்லாருக்கும் புரிஞ்சதா. Correct. So do you understand this too?
Yes, sir.
That's all. So this is the basis of the whole chapter. Okay, so shall we see some journal entries now? Hello.
Yes, sir.
Okay, very good. They have given so much of theory. Classification of ESOP. For accounting purpose, equity settled, cash settled, equity settled with cash alternative. These 3 only I told you just now. You understand?
Yes, sir.
All of you read these 3 points yourself. Or you read, ma? Dharini, you read it loud.
Classification of ESOPs for accounting purpose. For accounting purpose, ESOPs are classified into the following categories. Equity settled employee stock option plan is an employee stock option plan in which the enterprise receives services as consideration for its own equity instrument, including shares or share options, or receives service but has no obligation to settle the transaction with the employee.
So what is this? This is an arrangement, an agreement wherein the company is receiving services. The company is receiving employee service. Against what? The consideration is its own equity share. So I will give you my share. You please work for me. See, this is quite common, okay? As a student of CA intermediate, you might think these are very complex or rare arrangements, but trust me, this is, this is happening every day in every company, especially startups. I have seen so many startups of my juniors, okay? Even my articled assistants or my students, they have become chartered accountants and they started some technology companies. And also, very recently, one guy from Calicut called me and said, Pavan sir, can you be the advisor to this startup? So obviously, I'm a chartered accountant with 15 years experience. If I want to charge my fair value salary, do you think that guy will be able to pay me? He will die. Even if he sell his whole company also, he'll not be able to give 2-3 months salaries to me. So what they do, they will say, Pavan sir, we'll give you equity. So many shares in the company will give you. If the company is successful, if I unlock those shares, that value of shares will be very high. And in case of startup, every time startup will give some ESOP to CFO, CEO, these kind of people. So this happens, always this happens everywhere. In big companies like Microsoft and Facebook, as a matter of loyalty, respect, recognition, they will give. In small companies, to unlock the value, because they cannot bear me today, if I ask 5 lakhs monthly salary, they'll not be able to pay. But 15 years experience chartered accountant will obviously charge 4-5 lakhs per month. No, without 40-50 lakhs pay package, who will work? They'll not work. And these people cannot pay that. So what they do is, Pavan sir will give you 2,000 shares, will give you 5,000 shares. Like that it happens. So receive services. Receive services. And what is the consideration for the service? Your own equity share. That is first thing. Second thing, read this one.
Cash settled. Employee stock option plan is an employee stock option plan in which the enterprise acquires services by incurring a liability to transfer cash or other assets to employee of the amounts that are based on the price or value of equity instruments, including shares or share option of the enterprise or another group of enterprises.
Another group enterprise means my subsidiary company, my holding company, my associate, my joint venture company, like that. So what is this basically? You acquire service. This enterprise is acquiring services of employee, but not a promise to pay it in equity shares. I will pay cash only, but how much of cash? That depends on my equity share price. So after 3 years, I'm telling you, Dharani, work in my company for 3 years. I will pay you this salary, plus I will pay you cash based on my share market price. That means, imagine if Dharani is CF of my company. So today, share market price is, say, 300. After 5 years, share market price will be rupees X. So now I am entering into contract with Dharani that after 5 years, I will pay you the difference between X and 300 with a condition. What is the condition? X should be more than 500. Market price should go more than 500. Then I'll pay you cash, the difference between these two. So you take, okay, number of shares, I'll give you 2,000 shares. So Dharani, you take 2,000 shares. In my company, I have 1 crore shares, but I am giving 2,000 shares to Dharani. I will not issue this share. So this 2,000 shares, imagine after 5 years, Dharani worked excellent and she is a very good CFO and the share market price is say 750 rupees. Every month I am paying salary to Dharani. That is different. After 5 years, Dharani will get how much, 2,000 shares into 750 rupees, which is the market price of the share after 5 years, minus 300. She joined when the market price of share is 300. So she will get 9 lakh rupees as ESOP bonus. So this will be paid in cash, but cash is dependent on share price. Yes, guys, sir. All of you, do you understand this? Cash entitled is 9 lakhs, but how this 9 lakhs is calculated? Based on future market price of share.
Yes, sir.
Next, third one.
Employee share-based payment plan with cash alternatives. Under these plan, either the enterprise or the employee has a choice of whether the enterprise settles the payment in cash or by issue of shares.
That's all. Option is given. Okay, chalo. Now accounting. Put the heading. Accounting procedures. Equity settled. Accounting procedures. Equity settled. How much of theory they have given? No one will understand what the hell this is. Equity settled. Okay, under this, Hey, in the handwritten notebook, can someone tell me what is the page number? Sarah, what is the page number in the book, ma? Okay, search it, all of you. This is banking. Accounting standards. Buyback. It is page number 158. Page number 158. Okay, so first we'll start with these examples. Example 1. So Sarah, read this example 1 more.
Mr. A is CEO of X Limited. The company is happy with the work of CEO and gave an option to him to buy X Limited share at rupees 70. The market price of X Limited share is rupees 120. Since the option is favorable, Mr. A has exercised the option. Pass the journal entry.
So now 2 journal entries I have given. So read both the journal entries.
Option 1, bank account debtor 70 to equity share capital 10 to securities premium 60. Option 2, bank account debtor 70, salaries account debtor 50 to equity share capital 10 to securities premium 110.
So now all of you guys, you tell me which option is correct, option 1 or option 2? Everybody is saying 2. Correct. Correct. So all of you write this example in your notes. Copy this example in your notes. All of you copy this example in your notes. Make it fast. Once you are done, let me know in the chat box that you are done. Once you are done, let me know. Are you done? Once you copy this, please let me know in the chat box. Very good. What about others? Only 3 people, 4 people responded. Very good. So now, Sarah, read the explanation, please.
Journal entry 1 is wrong. It is the form.
Form means legal form. Form means legal form.
Journal entry 2 is correct. It is the substance of the transaction.
So in accounting, what do we consider? We consider form or substance over form?
Substance over form.
That is the reason we have written second journal entry. Now, all of you copy this box also. This is actually very important. Copy this box. Market price of share 120, exercise price 70, 50 rupees is fair value of option. This fair value option is benefit to the employee, but cost to the company. Since it is cost to the company, debit salaries or employee compensation. It goes to P&L, obviously. It goes to P&L. All of you copy this box and let me know that you are done. Very good. What about others? Okay, now let us go to ICI study material. Okay. Sandeep, read question number 1.
A company has its share capital divided into shares of rupees 10 each. On 1st April 2011, it granted 10,000 employees stock options at rupees 40 when the market price was rupees 130.
So what is fair value of option?
90.
Correct. Very good. Next.
The fair value of options calculated using an option pricing model is rupees 90 per option. The options were to be exercised between 15th March 2012 and 31st March 2012. The employees exercised their options for 9,500 shares only. The remaining options lapsed. The company closes its books on 31st March every year.
So one good news in this problem is, what is the safe or best thing in this problem? The whole problem started and ended within one accounting year. If you grant option in 1 year, after 2 years, if it is going to be issued, during these 2-3 years, there are employees resigning, there are employees joining, there are employees rejecting, then it will be complicated. But in this case, the whole story ended in 1 year and there is no, additions or deletions, straight single journal entry. Fact. Okay, so Sandeep, read the problem and can you tell me the journal entry? Can I say the company will get how much of cash? 9,500 shares into 40 rupees they'll receive, correct?
Yes, sir.
Okay, so can I say the journal entry as this cash account debit? How much?
3,80,000.
9,500 into 40, huh?
Yes, sir.
3 lakh?
80,000.
80,000. Next, second one.
Salaries
Salaries
account
account
debit.
What do we call it? Employee compensation expenses account debit. How much? Hey.
$8,55,000.
What is 90? Fair value. Okay, now to equity share capital. How many shares we are issuing? 9,500. What is the face value of share? 10 rupees. So how much you'll write?
95,000.
95,000. Okay, next.
To securities premium.
How much? 9,500 into
120.
Very good. 120. How come 40 plus 90 minus 10?
Okay, sir. $11,40,000.
This is the journal entry. So guys, all of you, please tell me, did you understand this? Sarah is saying yes. What about others? I want everybody to tell me. Dharini, yes. Vrinda, yes. Manoj, yes. Yes. Others, yes. Very good. So anyone who did not understand this journal entry? Sandeep, what is the next journal entry, ma?
Sir, at that time of exercise.
This is at the time of exercise only there.
Yes. Here, sir. Sorry, sir.
This salaries, where will you take? P&L or balance sheet?
P&L.
Then what is the journal entry?
P&L account debit to salaries.
Employee compensation. How much?
8,55,000.
So this is the answer, ladies and gentlemen. And can you believe this question is given for 4 marks so far 3-4 times? Easy problem or difficult problem? Really, this question is given in the exams. Everybody is asking really. Yeah. That's all. So you need to write this journal entry. Bank account debit 9,400 into 40, employee compensation 9,500 into 90, to equity share capital 9,500 into 10 rupees, to security premium balance. Then P&L account debit to employee compensation. That's all. And you'll write the narration also. Very good. So everybody is saying easy. See, I'll tell you one thing, okay? Basically, accounting is easy. But before, when you go to the accounting procedure, the background story is there. No, that is more important. So I'll put in every chapter, I'll put one story. So that will make you understand the concept. If you understand the concept, then journal entry easily you understand. There are students who struggle for this journal entries also. That means basically they did not understand the concept. Straight they'll go to the problem. So are we done with this? Can we move on? Ray, can we move on? Dharini madam, read question number 3.
Arihant Limited has its share capital divided into equity shares of rupees 10 each. On 1/10/2001, it granted 20,000 employee stock option of rupees 50 per share. When the market price was rupees 120 per share,
So tell me, what is the fair value of share? Fair value of option?
120.
Fair value of option. Akka, fair value of option, akka. Fair value of share
70.
120. Exercise price 50.
Yes.
Fair value of option
70.
Correct. Read.
The fair value of option calculated using an option price model is rupees 70 per option. The option were to be exercised between 10th December 2001 and 31st March 2002. The employee exercised their option for 16,000 shares only, and the remaining option lapsed. The company closes its books on 31st March every year. Show journal entry with narration as would appear in the books of the company up to 31st March 2002.
In this question also, one happy, beautiful thing is, it started on, when it started 1/10/2001, correct? 1/10/2000. It ended on 31st March 2002. Hamma, thank God. That means everything is within one accounting year. Remember, everything, if it is in one accounting year, accounting is damn simple. Only 2 journal entries will come. But
Yes, sir.
sometimes 4 to 5 years will be there in between these two. Then what to do? Pavan sir will do. You sit and enjoy. Correct? Huh?
We should learn, sir.
Dharani madam, one general knowledge question, madam.
Yes, sir.
Who will do this problem?
So we will do, sir.
Homework, class work?
Homework.
No, class work. I don't
Okay,
trust
sir.
you people.
Okay, sir.
If I give homework, out of 100 students, how many of them will do this problem? You tell me, Dharani.
50 students.
No way. 50 is too much of overrating. I think maybe around 20-25% of students will do.
Yes, sir.
Some people, what they do, you know, they conduct audit of the answer. They will take the answer and say, 16,050 debit, correct. Whether ICI has printed journal entry correct or not, they will audit. Okay. Some people will not do that also. So take 2 minutes of time, write the journal entry, then tell me that you are done. Then we'll go to next question. All of you, please do it. Manoj, are you done? Manoj. No answer. Priya madam, are you done? No answer. Sarah madam, are you done? Manoj is saying 1 minute. Okay.
Yes, sir.
Take 2 minutes. Priya done. Priya, tell me the answer. Priya, turn on the mic, please. Michelle tells, sir, I don't have mic, sir. Go. I will not talk to you. Priya, you have mic. No answer. Sandeep, are you done? Yes. Sandeep, tell me the answer.
The bank account debit rupees 8 lakh.
Bank account 8 lakhs. Okay.
Salaries account debit 11 lakh 20,000.
Salaries account for classroom purpose or understanding you can tell, but in the exam you need to write employee compensation expense or employee benefit expense.
Okay, sir.
If you do not write employee compensation or employee benefit, you will not get marks.
Okay.
Okay, it is something like, you know, when you are 2 years or 3 years old, you will not ask properly the food or you will not ask properly the water. So they will have some nickname. For example,
Yeah.
a kid ask water instead of water, they might ask some other word. So salaries is like that. Now you are grown up, no?
Yes, sir.
So you cannot go back to mom and say, mom, da. No, you have to properly ask. Correct?
Yes, sir.
Well,
Then to equity share capital 1,60,000.
huh.
To securities premium 17,60,000.
Very good. Next, second journal entry.
P&L account debted 11,20,000. To employee compensation expense 11,20,000.
You are reading looking at the screen or you are reading looking at your notebook?
Notes, sir.
Very good. So you wrote the narration also?
No, sir.
Narration who will write? Your grandmother will come.
In the exam, sir.
Hey, now you are not writing. In the exam, who will write? Write the journal entry now with narration.
Okay, sir.
All of you write the narration also. If you do not write the narration, no, they'll give you out of 4 marks, they'll give only 2 marks. So can we move further? Six and seven, they are very important models that we'll see later, little advanced. Sixth is actually advanced, seven is again basic model. Today we'll see 1 2 small problems and then big problems we'll see in the next class. So Sarah, read question number 1.
X Company Limited has its share capital divided into equity shares of rupees 10 each. On 1/4/2001, it granted 20,000 employees stock option at rupees 50 per share when the market price was 120 per share. Fair value per option was rupees 70. The options were to be exercised between 15th March 2002 and 31st March 2002. The employees exercised their options for 16,000 shares only, and the remaining options lapsed. The company closes its books on 31st March every year. Show journal entries with narration as would appear in books of company up to 31st March 2002.
So we'll write one letter to ICI. Dear ICI, if you are not creative of creating new problems, don't torture us with the same problem. At least in the name of God, change numbers. Same problem we have done.
Yes, sir.
You want to do it again?
No.
So anyone wants to do again, ask in your friends.
They are saying no, sir.
Okay. So second question.
S Limited grants.
Wait. Hello. Wait. I'm just looking at it. Shall we do it now or later? Because there are 3 years here. This is 2000, this 2003. We'll do it later. This is 1/4/2001, 1/3/2002, 31/3/2002. It seems to be 1 year. Read this.
The company has its share capital divided into shares of rupees 10 each. On 1/4/2001, it granted 5,000 employee stock options at 50 when the market price was 140. The fair value of option was 90. The options were to be exercised between 1/3/2002 and 31/3/2002. The employees exercised their options for 4,800 shares only. The remaining options lapsed. Past the journal entries for the year ended 31st March 2002 with regard to employee stock options.
So guys, all of you, if you observe one thing, okay, the story started with 5,000 shares. The story started with 5,000 options and the story ended with the 4,800 options. But because the story started and ended in the same financial year, we are not considering this 5,000 because I know that reality is only 4,800. So I don't need to estimate anything. So we are ignoring this 5,000. Now imagine if the story is transcending to 2 or 3 accounting years, your accounting will start with the 5,000 options. Are you getting my point? Hello?
Yes, sir.
All of you, please respond in the chat box. If the story goes to 2 to 3 years, then in the year in which you started accounting, you will start with 5,000 options. But because these problems now, whatever the problems we have done so far we have done some 2-3 problems or 3-4 problems. In every problem, the whole story is starting and ending within the same financial year. So I don't really need to worry about this 5,000 because I know that the reality is only 4,800. But in some problems, we'll start with 5,000. Then when we know that it is 4,800, we have to make some adjustments. It is like provision excess created. So you have created a provision for 10 lakh rupees, but you need to pay only 9 lakh rupees. Excess provision will be reversed. So like that, we'll do some reversal. But ignore all these things. Do you think this problem is basic problem? Yes. Pass the journal entry. Pass the journal entry. What are you waiting for? Once you are done, let me know. Hello, all of you. Are you done? Very good. So, Manoj, tell me the journal entry, ma.
Sir, bank account data 2,40,000.
Okay.
Employee compensation expense account 4,32,000.
Okay.
To equity share capital 48,000.
Okay.
To securities premium account 6,24,000.
All of you,
And
please
next,
tell me whether whatever he has done is correct. All of you in the chat box, please tell me the numbers he told. Do you agree with him? Yes. Very good. So what is the second journal entry, ma? Transfer employee compensation to P&L.
yes, sir. Profit and loss account data to employee compensation expense 4,32,000.
Okay, very good. So Manoj, you have written the journal entries also. I mean narrations also. Sorry.
Yes, sir.
Very good. Narration also is important. Manoj, read question number 5.
JKS Limited as its share capital divided into equity shares of 100 each.
100.
Sorry, sir. 10 each. 10 each.
One eyeball coconut size eyes are there. You have idiot. Read.
On 1/1/2011, it granted 5,000 employee stock option at 30 per share when market price was 50 per share.
What is the fair value of share? Fair value of option?
20.
Correct. Fair value is also known as intrinsic value. Intrinsic value is actually another concept, but for intermediate level, you can say either fair value or intrinsic value is same. Read.
The option were to be exercised between 15th March 2001 and 31st March 2001. The employee exercised their option for 3,600 shares only, and the remaining option lapsed. The company closed its books on 31st March every year. Show journal entries with the narration as would appear in the books of the company up to 31st March 2011.
I have one general knowledge doubt. The whole story ended in same financial year or no? Hello, all of you, please respond in the chat box whether the whole story started and ended in the same financial year or it is transcending from year to year, year to year, year to year. Same year. Very good. So accounting will be simple or complicated? Same year or year? Huh? Oh, that is year. Simple. So how many journal entries will be there? Two journal entries. So general knowledge question. Manoj, who will do this problem? I will do in class or you will do?
We will
Class work or homework?
homework.
Very good. Homework. Now Priya madam will get, not Priya, Dharini madam will get super anger like Hulk and she say, idiot, 2 minutes back I said homework, you did not agree. Now that guy is telling racist, Marxist, sexist, gender bias, no equality. On the day of judgment, God will fry you into pakoda. Pavan 65 will eat. Okay, read question number 4. Wait, Dharini will read. Dharini, read question number 4.
Illustration 4. Ajanta grants 120 shares option to each of its 460 employee. Each grant is conditional on the employee working of Ajanta over the next 3 years.
Working of Ajanta or working for Ajanta?
Working for Ajanta.
Okay.
Ajanta has estimated that the fair value of each share option is ₹12. Ajanta estimates that 25% of employee will leave during the 3-year period and so forfeit their rights to the share options. Everything turns out exactly as expected.
Required.
Calculate the amounts to be recognized as expense during the vesting period.
Super. So it is 1 year problem, 2 year problem or 3 year problem? Hello, Tangachi.
3 years
Tangachi means
problem.
sister, huh?
Yes, sir.
Younger sister.
Yes, sir.
No, then not Tangachi. Akka. You are elder than me, no?
No, sir.
No, you are only elder than me. I stopped aging after 17 years. I'm only growing. I'm not aging. Wow. So tell me.
3 years, sir.
So simple calculation or complicated calculation?
After learning simple, sir.
Take your calculator.
Yes, sir.
How many employees are there?
460 employees.
Take in calculator 460.
Yes, sir.
Okay. Per employee, how many options are given?
120 share options.
Into 120.
55,200.
Is equal to 55,200 options given.
Yes, sir.
Agreed?
Yes, sir.
One option, how much?
Fair value of each option 12.
So 55,200 into 12, how much?
6,62,400.
That is the total value of all options. Correct?
Yes, sir.
But in that 25% employees will resign in between. So do you
Yes,
need
sir.
to pay that 25 employees?
No, sir. 25%. No, sir.
25%. So your obligation is only for 75% employees.
Yes, sir.
Into 75%.
4,96,800.
Is that for 1 year or is
Yes.
that for 3 years?
3 years.
3 years divided by 3.
1,65,600.
That is for 1 year.
Yes, sir.
First year, how much? That much. Second year, how much?
1,65,000.
That much.
1,66,000.
Third year, how much?
1,65,600.
Correct. Okay. There is no change in the estimates from year to year. So our accounting is simple. Sometimes what they do, 22 employees left organization in first year. 81 employees left organization in second year. 28 employees left organization in third year. 25 employees did not accept the offer. Then you have to calculate every year. But this is easy, no?
Yes, sir.
Now check the answer. Did you get 165, 600 every year?
Yes, sir.
That's all. Year 1, year 2, year 3. So cumulative expenses for first year this much. Second year you add 1 and 2. Third year you add 1, 2, 3.
Yes, sir.
That's all. So all of you, do you understand this? Hello? Dharani, you understand this?
Yes, sir. Easy, sir.
Ask your friends whether they understand.
Everyone understood this problem?
Very good. So Dharani, in other countries,
Yes, sir.
how the teaching will be, you know?
How, sir?
If you go to Harvard, Stanford kind of universities, there will be one lecturer.
Okay, sir.
He is called course leader.
Okay, sir.
Then there will be one junior lecturer. He is called course moderator.
Okay, sir.
This course moderator will conduct seminar.
Yes, sir.
So weekly, one lecture will be there. 3 seminars will be there.
Yes, sir.
That one lecturer will come, explain the concept.
Yes, sir.
He will not tell the problems.
Oh,
He will only explain the concept. He's a senior.
okay,
He'll
sir.
explain the concept. So lecture will be only for 1.5 hours. After that, he'll go. So weekly for one module, only 1.5 hour lecture will be there, or 1 hour lecture will be there. After that, during the week, you'll have 3 seminars for same subject.
Yes, sir.
Then one junior lecturer will come, course moderator.
Okay, sir.
They will not teach anything. They will sit in the class and they will ask, solve problem number 1. You will solve problem number 1 and you will upload that in your website to main lecturer.
Okay, sir.
The beauty is there will be no exam.
Then?
At the end of the year, how many assignments you have submitted, based on that, they'll give you marks.
Jolly.
And there will be no exam. Exams are banned in some countries. You know that?
No,
Because
sir,
they,
I don't know.
you don't know? Seriously,
No.
they create psychological pressure. So in some countries, they banned exams.
Okay, sir.
For example, in the UK, if you go to any university to do masters, there will be no exam. Based on, you know, you have solved this first problem and you'll write the solution and you'll upload it in the portal. No, your main lecturer will see that and he'll give marks to you. That's all. If you get less than 50%, you need to sit in the next session again. But even then, no exam. Second time when you sit, they'll pass you.
And that will come to our countries.
You'll go to that country. Eh? So that is how the world is operating, but we are doing spoon feeding. I am only main lecturer. I am only junior lecturer. I am only theory. I am only problem. I am only housework, homework. I am only classwork, and I am only everything. You hardworking people. All in one. Now Sarah will tell, sorry, you are taking a full money. No. Chalo, are we done for the day? So you understand? See, this problem you understand, all of you?
Yes, sir.
Okay, very good. So this is all for the day. Remaining things we'll see in the next class. Okay, guys, any doubts? Guys, any doubts? Okay, very good. See you. Chalo, guys. See you in the next class. Bye. Take care.